Ho, 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 ho. Merry Christmas. Happy New Year. Season's greetings. Happy Hanukkah, although it's a little bit late. Happy Kwanzaa. Honestly, I don't know what the Hindus and Confucianists celebrate for the winter solstice, but all humanity does seem to celebrate something. And hey, I am all for you. Let's celebrate till Easter or till the cows come home, whatever. Well, it's that time of the year when I issue my forecasts for the Turkish economy and Turkish politics. I'm going to start with Turkish economy this year. 5 predictions. If you follow global economics, you would know that none of our predictions ever turn out to be true. We just scrapped them within a week after dropping the video. I'm sure this is not going to be different, but it's fun. If you have nothing to do over Christmas, let's just watch this video. It's going to be only 15 minutes. And, you can have a lot of fun with my mistakes. These are the 5 predictions. A, Turkish monetary policy will stay tight throughout 2024. If you follow Turkey, you would realize that my prediction cuts across the grain. It's against the consensus. 2, Turkish GDP growth, currently at 4% or so, will drop to 2%. That's the max. I am being generous to Mr. Mehmet Şimşek and his team. 3, current account inflation will drop to 40% by year-end 2024. To put it in perspective, inflation as of the November data at CPI level was something like 65%. I'm rounding up the numbers. Who cares if it is 64 or it's 66? The handle is 60, for Christ's sake. 60% per annum, At the end of the year, it's going to drop to 40%. Current account deficits, estimated to close the year at $46 billion, will probably decline to $30 billion. Just because one of the few remaining members of Real Turkey Channel audience asked, I'm also going to talk about Turkey's impending housing crash. I think by the end of 2024, the average price of a residential property would drop by 10 to 20% in American dollar terms. And finally, there is going to be a massive rally in Turkish financial markets. Did you absorb these? Are they easy to digest? Well, let's get started. And I'll try to explain why I'm making these forecasts. Monetary policy to stay tight throughout 2024. Well, if you have an inflation and a current account deficit problem, then obviously you use tight monetary policy. You complement that with tight fiscal policy. You cut people's incomes, and hopefully you engage in a program of structural reforms to make sure that the economy can grow faster without generating undue inflation or current account deficits. We don't have a structural reform program. Mr. Erdogan is structural reform himself. He's extremely arbitrary and discretionary. As long as he's in power, there is no hope for reform in Turkey. Fiscal policy is out of action for several reasons. First, because of indexing every year at the turn of the year, the minimum wage, pensions, civil service salaries, and wages are adjusted to inflation. And this year's adjustment rate is expected to be around 50%. It's better than last year when the minimum wage was raised by 107%. So it's difficult to cut the budget deficit when your personnel expenditures, which is the biggest item on your balance sheet, on your budget, are increasing by 50%. Also, we have earthquake expenditures, which have slowed down in the second half of this year, but they'll have to pick up pace because still millions of people are without permanent shelter in the devastated southern earthquake zone. If you want to know more about the earthquake, I think in February, I shot a video about that. Everything I said there turned out true. There is really very little that's going on to improve the lives of people there, maybe 10 million people. So essentially, you have only one leg of a stabilization program, which is tight monetary policy. And currently, the central bank's policy rate is 42.5%. Central bank will probably raise rates by another 250 basis points in January meeting and then stop to monitor the lagged and accumulated effects of monetary tightening on economic parameters. In other words, they're going to wait until end of the local elections to be held at the end of March 2024, then set a course for 2024. Now, because of base effects and the real appreciation of the Turkish lira, the majority of Turkey analysts expect that January's will be the last rate hike. Central bank will then just, course throughout the second and third quarter of the year and then start cutting interest rates. That's BS. The main problem with Turkish inflation is not cost push. It's still demand pull, which will be sort of taken care of. See my next prediction. But still, the third and most important component is price stickiness, inflationary expectations, which have been unmoored for 3 years. Add to that fact that nobody takes the official inflation figures seriously. If official CPI, as I've said, is 65%, the woman on the street thinks 75%, maybe 80%. So to change pricing behavior, monetary policy, like Fed used to say, stay to be tighter longer than imagined. And that, I think, will be the case in Turkey. Turkish policy rate will probably peak around 50% towards the third quarter of the year. And Turkish deposit rates at 60% per annum. Loan rates for average borrower about 70%. That should do the job on inflation. GDP growth to drop to 2% max. We could even have a recession for the simple reason that I don't have to explain it. There is something called the Phillips curve. If you are fighting inflation through tight monetary policy without any structural reforms, voila, you have to pay a price in terms of GDP growth. And if you look at central banks' inflation reports and their projections for 2024 inflation, it implicitly assumes that growth will drop significantly vis-a-vis 2023. Though, of course, that's not discussed in public because it's politically incorrect. Mr. Erdogan wants to have his cake and eat it, which means he wants lower inflation, lower current account deficit, and no change in growth. Strong growth, but we're gonna cure all the ailments of the economy. That happens Alice in the Wonderland, but it doesn't happen in Turkey. It doesn't happen on any country in this planet. And it's not gonna happen in the United States either. Just a little spoiler alert there. So 2% is a reasonable number if you wanna understand the mechanism. Obviously, consumer loans and consumer credit is going to drop significantly, which is going to affect domestic demand. It's reasonable, though not certain, that also private sector fixed investment will decelerate. I'm not saying for certain, because if Mehmet Şimşek and Gaye Erkan, central bank governors, can convince the people, the business community, that we now have a stable economy and the future is bright, then regardless of the cost of money, businesses will invest. But I'm not counting on it. I'm looking at fairly steady fiscal expenditures supporting growth, but private consumption and private fixed investment decelerating significantly. So that's gonna do the job of reducing GDP growth. Probably in the first half, it's gonna fare around 4% in annualized terms, then sometime around the summer, the inflation is going to hit the salary increases initiated by the turn of the year, and disposable incomes will start declining, consumers and businesses won't get any loans, they'll have to repay, and Turkish economy will slow down. The best news, I think, for foreign investors is that the current account deficits are going to decelerate significantly, probably by 33%. As I've said, we only got we got the October figures in balance of payments, but projecting from those, Turkey will close the year with a current account deficit of roughly $46 billion. I think there is a broad consensus with which I agree that the current account deficit will decelerate to $30 billion. The reasons are actually clear. Obviously, if you have lower domestic demand and lower GDP growth, your imports are going to decelerate. The bad news is exports are not going to do too well. Our main export destination, Europe, is probably going to remain in a growth recession throughout 2024. Though it's not as significant as the business community makes it out to be, the real appreciation of the lira is also going to undermine export growth. But on the other hand, we're probably going to get a bonus from oil prices. Turkey's major import item is energy. In 2023, we will have imported at least $50 billion worth of natural gas and raw crude oil. Now I know currently Brent prices are increasing again because of the hostilities in the Red Sea, the Gulf of Aden, etc., etc. But as I've mentioned in my previous video, they are projected to fall. I think currently Brent is around $80 per barrel, $60 to $70 per barrel is a reasonable number. If I were to bet, I would bet that oil prices would go below that because of price wars I anticipate, etc., etc. But at the end of the year, at the end of the story, I think current account deficits will become very manageable. And of course, financing will improve. Already, Turkey has done an outstanding job in terms of renewing the loans of the treasury as well as the private sector, and in fact borrowing slightly on top of that. So that does the main job of financing current account deficits. Next year, we're going to get a rather large inflow from financial investors because financial investors are already dipping their toes into the Turkish financial markets. That's stocks and bonds. There's really nothing else, and you can play the swap market if you want to. And I think all of them are waiting to see whether Mr. Mehmet Şimşek and Gaye Erkan will retain their jobs after the local elections. And of course, related to that, whether Mr. Erdogan will persist in his embrace of orthodox economic policies. My next video is going to be about Turkish politics in 2024. There I will explain in detail why Erdogan has no incentive to depart from the path of orthodoxy and why fire Mehmet Şimşek and Gaye Erkan, who are very popular with foreign investors and who are getting the job done. Once again, see my previous video or watch all my previous videos where you would conclude I am rarely bullish about the Turkish economy. This time I am. I mean, from a cyclical viewpoint, stabilization will be achieved. Turkish economy will move to a point where crises are not part of the daily cocktail conversations. Economic development, democracy, prosperity, better income distribution, not as long as Mr. Erdogan is alive. May he live for 10,000 years, of course. Okay, housing prices. Why will they crash? Why shouldn't they? Look, I checked with a couple of real estate brokers. In fact, you can't see outside the window because there's a sunny day. They are building a huge residential complex right across my gated community. I checked the prices there. Square meter prices are roughly $8,000. These are Manhattan prices. Well, maybe not prime real estate in Manhattan, but, you know, in the shittier parts. These are London prices. These are Paris prices. And compared to United States, to France or UK, Turkey's per capita GDP income, including purchasing power parity adjustments, is maybe a third of these countries, something like that. So at current level, housing prices have become unaffordable for the middle class. There are really no buyers. The second reason is the bubbles in housing, which drove up prices and increased transactions volumes, were not only created by the constant churning of the population, younger demographics, people need more houses, understood, but also because deposit rates were so low that a lot of savers, rich savers in particular, bought second or third houses, sort of, Turkish version of house flipping. Now, as of yesterday, I read in the news that the TL deposit rate shot up to 52%, which is still negative in real terms, but it's rising very rapidly. I mean, since the elections, the TL deposit rates increased from 30 to 50%, which is a massive increase. And of course, if deposit rates increase, since housing is an alternative investment, people will sell their houses or delay their purchases of houses for investment purposes and invest their savings into Turkish deposits. Also, look at China. Look at what's happening. Turkey is in the same position. I can't say we have overbuilt to the extent of China, but in the upper class segment, upper income segment, really just ritzy flats, we don't have that many single dwellings in Istanbul. The prices have gone just, have become out of the world. And that segment is going to shrink. So 10 to 20% drop in dollar terms. Now you gotta understand that most of my Turkish audience doesn't. In TL prices, house prices are never gonna fall because we have 60% inflation. If they were to fall, that would be like a 70% drop in housing prices, and that doesn't happen unless you live in Ukraine. A final prediction, massive rally in financial markets. Let's look at the situation. Going by my assumptions, local elections are over. Mehmet Şimşek, Gaye Erkan are still in their positions. They are stubborn in pursuing the stabilization program. Inflation is declining. Current account deficits are becoming manageable. And the Turkish lira is depreciating slower than the rate of inflation. Also, dollar TL implied volatility is extremely low. You don't need to know this, but it's important for carry trade, which means that foreign investors are going to flock to Turkish bond and equity markets. I think the consensus for 2024 is that India is going to become the bright star of the emerging markets world. Supply chains shifting to India, good domestic demand growth, some reforms by Modi, who is a religious fascist as far as I'm concerned, but not my problem. I don't live in India. And the second country is going to be Turkey. We have the turnaround story. They have a structural story of, getting more manufacturing and maybe in some service jobs, which were going to China. In Turkey, it's a question of things were so bad that we sold everything out. Now things are improving and we need to have some positions. And if that assumption materializes, then it's going to feed back into the others, because the more hot money a country receives, the stronger its central bank reserves become, the less likely that its currency would depreciate, which reduces inflation through the pass-through effect, inflation expectations, because people look at the currency and say, well, the currency is stable, so inflation must fall too. I mean, it's their logical assumption. And of course, as foreign investors buy Turkish foreign loans or lend to Turkey and buy Turkish bonds, the real interest rates will go down. So, knowing full well that latest by 15th of January, I'll have to go over these predictions once again and swallow humble pie, I say goodbye from Turkey for 2023 and Best wishes to all of you for 2024. We have very little traffic, doesn't really bother me. I'm gonna shoot these videos as long as I have something to say, but it would be nice if you subscribe or share it with friends who may be interested in Turkey. This is Atilla Eşilada. This video was broadcast by Real Turkey channel, saying goodbye from Istanbul.